You are listening to the War on the Rocks podcast on strategy, defense, and foreign affairs. My name's Ryan Evans. I'm the founder of War on the Rocks. There's this new ecosystem of defense companies, this new defense industrial base, the future defense industrial base, the future innovation base, whatever you want to call it. And it's starting to take off. And so I wanted to have a conversation about the relationship between defense and capital. And this is the first of those conversations. So I was really happy to sit down with Daniel Gwak, the managing partner of Point 72 Private Investments, the institutional private investing business of Point 72 Asset Management, and James Parker of Leonid. He is one of the founders there. Enjoy the show. Thank you both for joining me for this conversation. Let's start with you. Tell us how you got into this and where you come from.
Hey, I'm James. I come at this from the finance side into this market from a unique position in the sense that I came up as an engineer. Technically, came out of school with an astrophysics degree, but there are no jobs for people with undergraduate degrees in astrophysics, so you end up an engineer by default for some reason. First job out of school, I was at Mission Control. I was on the robotics desk at Mission Control at Johnson Space Center, and if you asked me then if I ever was going to have to find another job, I would have told you no. Unfortunately, a 21-year-old kid doesn't really understand the aspirations of a 21-year-old don't really jive with the bureaucratic nature of large-scale government programs, especially manned spaceflight. Ended up switching over to the unmanned side of things after some point or another, picked up clearance and went over and did a lot of real-time warfighter and operator support from space-based assets. At some point in the aerospace world, you have to make a decision. Are you going to go hardcore engineering or are you going to go business? And I went business side. Ended up at business school. Spent a bunch of time, after business school, realized I caught the finance bug, ended up at Alvarez and Marsal, which is one of the larger turnaround and restructuring firms in the country. Great education, especially coming out of a non-traditional background for finance. And ultimately, from there, went in and got into interim executive management, some private equity work. I had a cup of coffee at a bank. But it's really all of those experiences, that Venn diagram of all of it that led me to what we do now. It's this weird combination of understanding how the balance sheets of these small companies, these small defense contractors actually get treated from a credit perspective, the challenges of how those businesses are running from a cash flow perspective, and then frankly, the uniqueness of the aerospace and defense world and the government customer.
Hey, so I'm Dan. I lead the private investments business at Point 72. On the venture side, I focus a lot on defense tech, and how I got into defense tech was that, before my time at Point 72, I was at a place called Incutel, which is the strategic venture firm of the U.S. intelligence community. That job is as fun as it sounds, and so learned a ton there, especially on the technical side. Before that, I had a bit of a mixed background, which I think is pretty common in the defense tech industry, whether you're on the startup side or on the investor side. Pre-business school, I had a mixed background, both in finance and private equity, as well as in the military, where I was an enlisted Marine.
What did you do in the Marine Corps?
I was an infantryman. So I went through school of infantry as an infantry assaultman, which is a MOS that no longer exists. And so by the time I got out, I was a machine gun team leader.
Both of you come at this issue of capital and defense from different perspectives, but ways in which relate a lot. So, Leonid basically lends money to companies that have defense contracts. What made you, most banks balk at that. Having been through that before, banks do not want that, even if you're like, hey, here's a contract, and they're definitely paying us this much money, and they're like, don't like government. What attracted you to what seems to most other financial institutions to be such a risky business?
When we started Leonid, quite frankly, we started out a factoring shop. We were buying people's government invoices. It's great paper. The government has literally never defaulted on a valid invoice.
For people who don't know what those terms mean, what does factoring mean? What does it mean to buy someone's invoices?
It means in this case, a government contractor has billed the government, and there's a 30 to 45 day payment window. It's the net payment cycle. We generally see that book turns at about 37 days. So on average, a government invoice will get paid in about 37 days. If you want to clip off the waiting time, a factoring shop will come and buy that invoice from you. And then they get paid they have the rights to the payment from the government. For that, they charge a small fee. It's usually based on the days outstanding, and it's a daily interest rate. We started out that way because, quite frankly, that's how it's always been done in government specialty finance because of this issue with banks. The primary conflict that banks have with government contracts is that the government maintains a 30-day cancellation rate, 30-day notice cancellation rate on every contract. So the banks don't view them as contracts. They view them as future cash flow streams that could disappear essentially overnight. So no bank that is operating on fairly thin spreads, fairly thin margins, wants to loan multi-year money against future cash flow streams that could disappear on Tuesday. That's what's kept almost everybody out of this world to date. When we were spun up our factoring shop, we were focusing on early stage research companies, people with SIBRs, phase ones, phase twos primarily. They kept on coming to us and saying, you guys are solving our 37-day cash flow problem just fine, but what I really want to do is make an investment in my business. But my only assets are the 5 researchers that I've got that walk out the door at 5 o'clock every day, and this contract, which nobody views as an asset. What we decided to do to gain conviction on it is to ask the question, recognizing that the government has the right to cancel a contract, how often do they actually do so? Unfortunately, there's a wealth of public data out there that we went and grabbed 2 terabytes of public spending data. It's 15 million lines of Excel. It's 10 years of payment performance history, all in our niche. Small and medium-sized businesses, overweight special set-asides, overweight national security, contracts under $50 million. And we found that contracts by number get canceled about 1% a year, but critically, the 1% that get canceled actually collect 97.1% of the original total contracted proceeds before they're terminated. So you end up with a dollar default rate, or like the dollars lost left on the table for your average contract in our niche is actually 0.012%, which is 3 orders of magnitude less than the accepted corporate default rate. When we got to that information or that realization, we realized we could start structuring up unique term loans, revolving lines of credit based on people's contracts. And it's something that hasn't really existed in the market before. So we've seen a tremendous demand for it, especially in the early stage sides.
And how long has Leonid been around doing this now?
This has been about 18 months in this strategy, and we started this whole thing in 2019. So
very exciting. And in terms of the venture world, and you know, it's changed a lot over the last, I don't know, let's just say 10 years, but even the last 3 years, I'd say. How long have you been doing venture in defense tech now?
So I've been in venture since my time at InQtel, right? So about a decade now.
So what are the big changes that you've seen?
So I would say within the world of defense tech, the biggest change that I have seen is the emergence of defense tech startups, right? And I would say that that's something that's been a good idea only in the last 3 to 5 years, right? And I would draw a distinction between defense tech and dual use in that defense tech startups truly are focused on scaling their businesses by selling to one primary customer, and that is the government, right? Dual use has been around for a long time. It's always been kind of a good idea because really what it means is that the government is going out and buying the best-in-class version of some software product or some technology product that's already the best in the world. That's a good idea, yesterday, and that'll be a good idea tomorrow. Right. But for the stars to align in a way that it makes sense to start a company, shoot for a multi-billion-dollar outcome on the basis of I'm going to sell something specifically to the government, that is only recently what I would call a good idea.
And why has it become a good idea? What's changed?
Well, selling to government is always hard, right? There's effectively 3 things that need to line up, right? You need the appropriators in Congress to decide that it's a priority and put real, money towards it. You need to have the users who see value in the product. And then you need the connective layer, which are the program managers, right? They're the economic buyer, if you will, right? Anytime you're talking about a 3-way bank shot to get to a sale, that's a long process, right? And typically, as a venture investor, you wouldn't want to bet on a 3-way bank shot. It's hard enough to make money selling one thing directly into a market that needs the product, right? And I think you have some experience with with how hard that can be. What has changed, I would say, in the last 3 to 5 years is that at least 2 out of those 3 pieces of the puzzle are pretty well sorted today in a way that they weren't, 3 to 5 years ago, right? So, if you think about how the appropriators are thinking about defense tech and how technology can impact, our national security, there's a much stronger awareness now that, things like AI, autonomy, large language models and information warfare and things like this that can actually shift the global superpower balance, right? And you really do need that realization before, a place as complicated as Congress really kind of like aligns around, putting real budget towards it. And at the same time, the technology is broken through in a way that I think the users now can really see that, hey, this can make a big difference in my day-to-day, right? This can make a big difference in the fight that we're facing. And so when you've got at least two out of three of those things locked in place, then it's about stitching together the third piece, right? And that's a much more tractable problem than where we were, call it half a decade ago, where there wasn't necessarily that awareness at the universal awareness anyway, at the appropriator level, right? It was mostly excitement just at the user level, which, again, I'm a former Marine, like my heart goes out to the users. That's, where my sympathies lie. But you talk to most users, they have no idea how to get things purchased, right? You can't just rely on user enthusiasm. You have to be able to stitch those other pieces together, and it's finally possible.
Your customers already have government contracts, so they've already aligned those three things. But I imagine they still face problems with their customers. What kind of problems are you seeing them face still?
Usually the problems we have are delays in billing, in CLIN billings or milestone billings. Recently, obviously, there have been certain issues, especially on certain research projects where COVID caused massive delays. They couldn't have access to a particular base for 12 months. And that could delay execution on particular contracts. Sometimes the contracting officer goes on TDY, right? And nobody knows how to get to him and nobody knows how to bill it. Fortunately, since we came up in this world, we understand it. So we don't have the same sort of requirements that a traditional bank would have. We don't charge a monthly mortgage payment. We get paid when they get paid. So we've purposely structured our products because we understand how the contracts work. And we understand there can be delays. There can be situations where the contractor is performing perfectly well, but then they come back and the customer comes back and says, I'd like you to add this extra part of the report. And technically, the contractor's got a right to say, yeah, but you can just pay me now, but nobody wants to piss them off. So they go back and they do another 2 months of research, and that can delay things. Well, if they have a traditional loan from somebody, that mortgage is going to keep coming every month. And it just you've loaned somebody money so they could pay you back with that same money, which is not a very good business model.
Because they're going to get paid eventually. My other company, Bedrock, had a problem with DFAS, the Defense Financing Accounting Service. Those are not uncommon, but the money eventually came. It just took a few weeks longer than it should have. So it's these sort of more bureaucratic administrative things. But what about when it comes to growth? So let's say, I imagine some of your customers have IDIQs, indefinite delivery, indefinite quantity contracts, which are basically these contract vehicles that lots of other people can join that can get a lot bigger without having to change the fundamental terms of it. What challenges are you seeing with your customers in growing those into bigger opportunities?
I think the bigger issue is less turning that into bigger opportunities. It's the idea that these sort of headline grabbing numbers on IDIQs mean something. And they, not to be pejorative here, they just don't.
Yes. When
right?
someone says they've won a $1 billion IDIQ, that doesn't mean they've gotten $1 billion. Yeah.
But they have a tendency to think that there's already a confusion in the market that the government, when people get their first big contract, most of our clients have already gone to their local bank and said, good news, everybody. I won a $20 million contract. Now can you loan me money? And they say, we'll give you a $50,000 personally guaranteed corporate credit card. Right. And those people turn around and say, but I have to hire 12 TS cleared AI engineers. That doesn't help me. Right. So the IDIQ is a very similar thing. They go in with a headline number. They've got this idea. They put a great press release out. The meat of it is what's important to us. And I just think it sets up, I think contracts like that, I think people look at it a little bit too, it's almost like a marketing document. It's not actually anything functional for their business. It can, if they execute on it, they can build on it and that's great. But when it comes down to a financial transaction, like we only operate on contractual
there are other documents. They're like, here's what we're actually going to pay for this year.
And that's what we work on. Yeah.
You talked about dual use and defense tech, and you're right, they're separate categories. But I think there's a Venn diagram in one places that especially companies like Bedrock, for example, but there's also others in the more traditional technology aerospace world that are relying on their dual use, but they're relying on government as their first initial market to create that stability and growth. before they can capitalize on corporate opportunities. Maybe because they're relying on government R&D, or maybe just because the government gets it sooner than some other corporate customers might, for whatever reason. Are you seeing that in your portfolio as well, or what are your thoughts on that?
Yeah, our portfolio tends to be a little bit more clearly delineated between companies that are, what I'll call defense tech, kind of going after the government customer first and foremost, and that's what's going to make them a large company. And then, dual use, where, again, it's like, hey, we've underwritten the investment case mostly based on the commercial traction that the company can get outside of the government customers, right? When we think about it through that lens, really through the venture lens, it's the what do you have to believe, right? On the dual use side, if you can believe the story on the much more straightforward commercial go-to-market, then the government go-to-market is a kind of like kicker to that can really accelerate the company. On the other hand, if you're having to underwrite the business based on the government go-to-market, which is inherently very different, then you just look at it a different way.
Something else I'm seeing, I'm just curious for both of your thoughts on this, is I'm seeing a lot more non-US companies starting US companies and really trying to break into the defense market here because world's largest customer in defense technology is the US Department of Defense. Are you working with or having touch points with any of those companies? And what do you think about the challenges they face versus homegrown US companies?
From a venture perspective, first of all, non-US, there's a big difference between whether you're talking about an Australian startup or a Chinese startup, right? So, holding aside the...
Yeah, let's assume it's from a NATO ally.
Right. Yeah, from
Canada, France, UK.
Yeah. From the NATO ally perspective, what matters a little bit less than where the company is based is the background of the founders, right? To your point, the U.S. defense market is the largest in the world, right? If you look at the U.S. and its allies, the total spending on defense is $1.6 trillion. Gigantic market, right? But half of that, literally $800 billion of it, is just U.S. spending, right? And so if you're going to build a defense tech company, it would make sense to take a bite at that apple first, right? If you can't crack that nut, then it's going to be a much slower slog trying to open a bunch of other doors that are a lot smaller. And so from that perspective, regardless of where the company is founded, it does help tremendously to have a founder who is familiar with U.S., defense problems, U.S. defense users, and has, relationships within these places so they can get a clean view of the users, the way appropriations work, the way that, you have to navigate, kind of that economic buyer that exists in the U.S., which might be a unique construct that we have here and it doesn't necessarily exist in every other place. And so, the background of the founders, as with really any venture deal, matters a lot, right? Does the company need to be American? Not necessarily, but does it help to have people who are familiar with the American defense, technology problem? I think that's a requirement.
We generally see sort of the opposite problem, where somebody wants our help as it relates to their foreign military sales. Like, well, I can get a contract with the MOD either in the
Offsets
UK
or something.
Yeah, it's something in the sense that, like, I have a contract with a different government. Can you help me? And our answer to that is, one, we're sticking to our knitting on the U.S. side of things. Two, I assume, and I've been told the MOD in the UK and in Australia works extremely similar to here. I don't actually know that. I don't know how to navigate those systems. I don't know if they've got the assignment of claims process or all the things we've put in for our mousetrap. I'd have to reinvent that for those markets. So we have a tendency to avoid it in that sense.
And I think the British and Australian, they are very different. I mean, from what I'm not an expert on either, but I've worked very closely with British troops, and I know companies doing business in Australia, and I hear the Australians can actually move pretty fast. But of course, their budget's a lot smaller, so that's the trade-off for a U.S. company. You mentioned the founders, and it's important for them to have that knowledge. I want to pull out something from both of you guys. So we're seeing this rise of smaller venture firms. So, like our friends at Decisive Point, Squadra, J2, a few others that are really active in the defense tech and dual use space. And I think their major offer, aside from, of course, cash, which is important, is expertise on how to work with the Defense Department. Because a lot of technologists in the U.S. themselves, for totally understandable reasons, do not understand the U.S. Defense Department and how it works and how it buys things. And and they offer that expertise in-house, which I think can be useful. What do you guys think of that phenomenon and the ability of those smaller venture firms to scale massive companies through their investments?
I think it's tremendously valuable, right? In the earliest stage of venture investing, you really don't have a lot of signal or data to go on other than the team, the idea of the product they want to build, and a knowledge of whether that market is attractive or not, right? That in defense tech takes years to build up in terms of domain expertise, right? Selling, commercial products also takes expertise, but not a lot of that expertise is transferable. And so having early stage investors who are very kind of specialized in that makes a ton of sense to me, right? Now, why does that matter so much in the early stage? It's because in the later stages, typically revenue kind of cures all evils, if you will, right? It doesn't take a deep amount of domain knowledge to see revenue, triple from one year to the next and say, hey, there's something going on here, right? Like that is something that's a language that a lot of investors speak, right? And so that specialization at the early stage, I think, does matter a lot.
I agree. It's extremely valuable. We purposely stay out of that. We get called, I would say almost daily. People contact us and they say, can you help me get a contract? And, we have to politely decline because that's not our expertise. And we don't want to send the wrong messaging that we have some sort of secret unlock in how to do that. So like we have a suite of referral partners we send people to, especially on the cyber side of things. But, it's a definite need. I can definitely see the advantage, especially in venture, because you're getting in sort of ahead of maybe even their first contract, right? It's a concept of technology at that point, and you're hoping that the government picks it up. So you need that side of it. For our side, for our business, again, we operate on dual executed contracts. And the one thing I don't want to be something I'm not, and right now I've got a hard enough job making sure that I underwrite everybody and control my risk, because in my business, I don't have 10Xs that make up for 5 portfolio misses, for 5 zeros in a portfolio. I can't lose money on one deal because I'm on the credit side. So we hammer down on that part, on what we know how to do, and let the experts do.
But you have that slow and definitely, like, you don't have the hockey stick curve, but totally reliable, repeatable, growing revenue.
Credit has always been a good investment. Like at the end of the day, credit has always been one of the major categories of investment. It doesn't have a major high, the important from an investor allocation perspective, you want parts of all of it. You need big hits. You want to do, kind of mid-tier returns on private equity, and you need credit because it's safer, right? So
why do you think venture firms, private equity, banks have not started doing what you're doing yet? Is it just insight and imagination and knowledge, or is it just they're too cautious, or what is it?
No, they just have their own specialty. Like if they're a venture
you said
shop,
they should balance, right? So
that's if you're a investor. If you're a capital allocator, you want some money in all of those pockets. But venture investors don't do credit. Venture investors don't even do venture debt, right? There's venture debt shops to support specific venture investors. So the trick is specialization, right? And then if you're the pension funds, if you're the institutional money manager, you want bits of all of it. And it's important to have sort of the bedrock of credit because it's considered the secure part, but you need the tail of venture because that's where your returns really go through the roof. Like you get 1,000x return and it makes up for everything.
You mentioned venture debt. One thing that I found interesting when we were doing my other company, our Cyber Phase 2, is that to qualify for the matching, because the way it works for those of you who aren't familiar with small business innovation research contracts, you get that phase 2, which comes with some R&D money, which is great. And then they'll give you more if you raise capital up to a certain amount. But that capital has to be a priced round. So you have to go out, and what that means is you go out, you say, my company's worth this much, and when you invest this much, you'll get this percentage. But they don't allow convertible notes, which is essentially debt. Do you think that's a bad idea? Or do you think the Defense Department should incentivize different colors of money from investors beyond just priced rounds?
In my opinion, the more flexibility, the better, right? It's not that there's a lack of volume of money, right, that the government is spending. It's that it's all tied up in different colors of money, different ways that it can be spent, different timing with which it can be released. All of these complexities have a cost, right? They're not cost free. The more complexities you layer on, whether it's like, hey, a priced round is okay, but a convertible note is not, and so on and so forth, you butt a little bit closer to the line of it's not worth going after that money because it's too complicated, right? And I think that's unfortunately kind of the tragedy of it, right? Because for this money to be available in the first place, like somebody had to really roll a big rock uphill, right? Getting things done in government, not easy, right? And probably in the process of doing so, a bunch of complexity got attached for the sake of getting it done. And then what ends up at the other side of that is oftentimes a vehicle that's very hard to use, right? And so I would generally advocate for, let the private sector determine what is the right, kind of form of funding. Sometimes, in some cases, convertible debt rounds make the most sense. Sometimes priced rounds make the most sense.
Well, and it's also a exogenous market thing. It's like when COVID happens and their stock market goes crazy, then it almost crashes and all this stuff, or we're going to have recession. The preferences of investors change along with that, whereas the government's rules don't, right?
And I think that's a great example of why that flexibility really helps.
Yeah.
Or would help.
I think it's also, frankly, just it's a locked mindset on what the word investment means. Giving somebody a loan is an investment in that company. And we approached TACFI, StratFi, trying to figure out if our contract-based loans would
break down
qualify.
what those are. TACFI, StratFi.
TACFI and StratFi are Air Force-specific matching fund programs for people who have SBIR Phase 2s. And you get I forget exactly the number. I think it's 2-to-1 on TACFIs. So if you raise a certain amount of equity, you can get a follow-on contract. It's usually a P number modification on that contract of the existing work you've already done with more milestones and an additional set of contracting dollars from the government. So it's a way of doubling up your equity investment, call it, sometimes more. We approached them about our loans. Can this qualify as an investment in the business? And we were told very directly, no, because your priority is getting your money back.
As if other investors don't care about that? Yeah.
That's why I'm laughing as I hear that. I'm like,
you said it, not
we
me.
care about?
No, it very distinctly, that was their response, is that your main priority is getting your loan repaid, not in the investment in the business. And that makes no sense to me.
Without obviously not naming names, but what was the person's job who told you that?
I think I read it in in the AFWorks, like TACFI, StratFi presentation. Like it's labeled right there. We thought we had an in. And we tried to make our pitch on it, and we were told, we actually got an early read that it was going to be allowed, and then it was rapidly not allowed after that. But then as we went and dove into it more to try to understand why that decision was made, it's written right down. Debt does not count because the priority of a debt holder is to be repaid, which doesn't make any sense to me because that's what any investor's priority is to make more money or to get, certainly, they're not investing out of altruism. Obviously, if they're investing in defense tech, hopefully they have a patriotic or a mission-oriented mindset, but they still have investment returns to create, and they have stakeholders that expect certain levels of performance. So, and to your point, anything that gets more money into this ecosystem should be encouraged, right? At the end of the day, we need more of this. We're falling behind in a lot of this technology. These companies are small. Usually the business, running a business is hard. Dealing with the government customer is difficult. We need to be knocking down barriers to encourage more people to be participating in this market, not boxing people into if you're one of the, you're one of the chosen few that can actually pull down a $5 million, equity raise in a price round, then you're the one that's going to be allowed to go forward.
So another thing I'd like to, for every 0.72, which of course is, I'd like you to get into this, but before I ask a question, 0.72 is not just venture. It's in some ways actually pretty unconventional in how it's organized. So break down
So 0.72 is a large asset manager run by Steve Cohen. Within 0.72, there are multiple businesses. The business that I run is called 0.72 Private Investments, and housed within the private investments business are ventures, growth, and hyperscale, which is a private equity strategy.
Great. So for every 0.72 with especially with its venture aspect in defense tech, for every one of those, for what the great things that Leonid is doing for Lux Capital, which very much believes in defense investments, Raj Shah's Shield Capital. He was, of course, the former head of the Defense Innovation Unit when it was still experimental, and for every America's Frontier Fund. There's so many more traditional players, especially in Silicon Valley, that are openly ideologically opposed to investing in companies that are doing defense tech or have large public sector markets, or just sort of have contempt for them, or just don't understand it and are scared of it. I've had multiple venture, the people that Dot Sandhill wrote especially, they just don't get it. I think there's a real ignorance about how the government, the US government, which is the world's largest customer, and the Defense Department, which is the largest customer within that largest customer, works, and actually how much money there is to be made, especially with such a reliable customer that needs these technologies and says it needs these technologies, especially during times of economic uncertainty when we have inflation, we might face a recession at some point. Government's the best customer during these time periods. Why do you think that Silicon Valley is still so scared of the world's largest customer?
I think there's two primary reasons, right? One is just not understanding how to underwrite the investment case for a company that is going to scale by selling it to government, right? It is very different, right? And the investment universe is a place that is only getting more and more specialized. And so I would say defense tech is one of these places where if you show up and this is the only defense tech deal you've ever seen, your likelihood of being able to get to conviction before one of the early stage investors who focus on defense tech does is very low, right? And so from that perspective, what's going to change that? Returns will change that, right? So when the funds that are focused on defense tech generate really compelling returns, other investors will look at that and say, okay, you know what? I'm going to spend the time to get educated on, this on this sector of tech investing, right? And that's a pretty natural thing. The other is, I think you were, as you were alluding to, some of it is cultural, right? Some folks just don't want to invest in defense tech, right? I would say that's probably a pattern that's true of defense in general. It can be very polarizing, right? I certainly think back to like when I enlisted in the Marines, it was one of these high conviction decisions. I don't think anybody could have talked me into it or talked me out of it, right? And I think that is probably more true in things that touch defense than in other commercial realms.
I think color of money is a problem too. I mean, it's hard to raise $5, $6, $7, $10 billion for these large scale funds without going out into the global market. And that usually these days comes with PRC money, with Russian money, with Gulf state money, and that can cause conflicts based on actual investment decisions afterwards. I mean, I know the stories we hear that, Weibo Ventures puts $50,000 on every single cap table of any interesting to borderline defense tech cap table they can find, ostensibly as a way of blocking them from working with the U.S. government. And founders take that capital because it's underneath the official foreign capital limitations. But the CIA has, their limit is zero. Like we've heard that directly. Like we won't let you. You could probably correct me on that if I'm wrong. But if you take money from the wrong place, then you are blocked from working with the government. So I think you have an upstream issue as well in Silicon Valley, is that you have to go out to these global markets to pull in capital. And then that can effectively siphon you off of certain angles just because that money doesn't flow that way.
Yeah, there's lots. We published a great article. I don't know if you guys read it, Leveraging U.S. Capital Markets to Support the Future Industrial Network. And it was by General Votella, Frank Finelli, Sam Cole. And, the point they make is, and this is mostly a DOD problem, I think, in a lot of ways, but not just DOD. This is all a failure of imagination, in my opinion. But they point out that there's $46 trillion in public capitalization and another $10 trillion in private money just in the U.S. capital markets that's just not really being leveraged to be applied to these problems. And I think I'm not saying you're wrong, but I think that there's just all this money sitting out there that could be used for this purpose. Obviously, it's not as simple as that, and they lay out in the article some very detailed ideas on how to do it. But we're just not. It's the same with building technology. It's usually on the limits of technology that people stumble on. It's imagination and how to use, deploy, and design it.
Yeah, I think that's right. And, especially in the venture universe, when you look at, how many defense tech companies have grown to be worth over $1 billion, it's like a half dozen. That's still not a big number, right? Yeah. And so, and that's understandable. This is really, again, only shifted in the last few years, right? And so I think for venture investors to broadly become interested in the space, you need to have more than half a dozen companies that are worth $1 billion, right? The average, call it junior partner at a venture firm today who needs to pick what they're going to specialize in, right? Which is largely going to determine the success of their career, right? If they look at defense tech from the outside, they're only going to see a half dozen companies that were worth $1 billion or more. Whereas, you look at like mobile apps or whatever else, right? And there's just hundreds of examples. And so, part of it is it's very early, it's very nascent. Industry still needs to grow up, prove a bunch of returns, and that'll naturally kind of spark that imagination, right? It'll cause investors who maybe were a little bit more around the periphery to say, okay, you know what? I'm gonna bet on this, right? And that's really an investment of time and getting educated and talking to the right people and so forth.
It's kind of like the analogy. It's an analogy to, or analogous to, we say this in the engineering circuit, right? In the 1960s, the greatest minds in our country were focused on putting a man on the moon, and now they're focused on how to push more ads on people, right?
Like, or new ways for teenagers to share photos with each other.
So it becomes just a different, like, to your point, the junior partner, like, he has to decide, and with his career, what's he going to do? Like,
I think a lot of people are waiting to see what happens with Anduril, and they're watching what continues to happen with Palantir and what Palantir's next chapter looks like. And I think that those are sort of the signal case studies. I don't know if you guys are invested in them or not, and I don't need to know, but like, I think a lot of people are waiting to see what happens there. Anyway, thank you both for joining. This was great. Thank you for listening to this episode of the War on the Rocks podcast. Again, this is the first of a series in conversations about defense and capital. Do not forget to check out our membership program at warontherocks.com/membership for a very low, reasonable annual price. You get access to all sorts of extra cool stuff. And stay safe and stay healthy.